Good morning. We're going to look at chapter 13 today in our text, Internal Auditing and Control Systems. This is a long chapter, maybe the longest one in the book, one of the better ones as well, because here we're starting to see some how all this comes together for conducting the assurance engagement, the audit engagement. If you turn with me on page 13-3, this particular chapter uses a books to buy company for sort of presentation purposes as an example of what goes on with internal audit. And I like this particular example because it's the accounts payable and disbursements process, which is very typical of most firms. How do you control your accounts payable? And the other side of that is how you control your payroll. That's pretty much everything that flows out of your company as far as cash flow. And so there's a lot of internal audit time is spent on these processes. So we're going to look at this really purchase to payables that I talked about several chapters ago and gave you an SAP PowerPoint that we went through showing the three-way match, right? Purchase requisition, receiving ticket, and invoice. Of course, this sort of builds on that, although they have a little bit different twist on it, which I'll talk about. But what we see here is on 13.3, determining the engagement objectives and scope. Obviously, a big part of any engagement is planning this out, and you have to start with what are your objectives here? What are your objectives? Is it about, I guess, identifying the internal audit plan of the inherent risk during the business risk assessment process? Page 13.4, maybe it's a part of the annual requirement here that's not just about risk, as I just talked about. It's about the annual requirement to evaluate internal control. You know, Sarbanes-Oxley 404. SOX 404 is about internal controls, and that's very important. Maybe there's been a recent event. You know, we just went through this COVID crisis. What kind of impact does that have on controls and on your internal audit, your processes, your efficiency, your effectiveness, as well as how a lot of things are sort of taking a back seat to making sure you stay in business. So maybe COVID has an impact on having an audit based on this, or an engagement, assurance engagement. Maybe changes in the business or the industry requires immediate modifications. So we need to, first of all, there on 13.5, establish what the engagement objectives are. Now, I like the terminology they use here to say evaluate the design adequacy or determine the operating effectiveness. Very important. Assessing compliance, determining the effectiveness and efficiency of operations, evaluating accuracy, assessing achievement, determining the performance. See, all those are very good objectives in terminology that is used there, very specific. But these objectives have to be set forth at the beginning of the engagement. That's a critical part of this, or else you lose sight of what it is you're trying to accomplish and when you're done. The scope as well. What is the scope? You can't do everything. You've got limited resources. So what is the scope? What's the boundaries? What's in scope? What's out of scope? Are you talking about auditing just one location from a corporate level and leaving the others? Or are you doing something that's all encompassing? Maybe the controls at one location will tell you what's going on in another location. So what scope do you have? Do you have the manpower? Do you have the resources, financial resources for travel and so forth? What's the time frame? Usually it's over a calendar year, but it may be just a point in time, like a balance sheet is a point in time. What's the expected outcomes and deliverables? They're on page 13-7. After you set forth your objectives and the scope, what's the deliverables from this? Really planning on what is the end game. And so really you've got potential outcomes of the tests that are going to be performed. What's the auditee, the people you're auditing? What's the auditee expectations regarding engagement communications? Because they're all wondering, when's the report coming out? How's that going to be disseminated? A lot of information here. And on 13.8, they go into detail about you need to understand the auditee. And I've said that over and over again. Understanding the process, what the company's business is, your firm. And that's why internal audit is such a key part of any company, to learn about your operations. What's the causal effect of production to your materials and supply chain logistics, and ultimately to your financials. So understanding your auditee and the processes. In this particular case, we're looking at, in this chapter, we're using this cash disbursements process to sort of hit home on a lot of these different specifics that you want to talk about or you want to focus on. But there may be a lot of objectives there listed on 13.8. Are you paying bills accurately? And so to avoid future adjustments. Are these obligations to pay? You could read that for yourself on 13.8, 13.9. Maybe another example on 13.9 there says internal reporting of cash flow. Helps the treasurer prepare weekly cash flow, moving funds from maybe a corporate sweep account to a corporate sweep account from another account. What's the delegation of authority going on here? Obviously, when checks are generated or authorized, there's an additional signature needed for anything over 5,000 or 50,000 or whatever that might be. What kind of authority policies are in place? Do you have bench strength among the staff? I mean, do you have qualified staff working in this disbursement area, in accounts payable, in purchasing, right? They are controlling this, a three-way match. Purchase orders and invoices, and of course the receipt of goods or services rendered is a third leg of that triangle. Cross-training there, bottom page 13.9, cross-training individuals in all department jobs to ensure at least 2 people are capable of performing all key departmental tasks. Then the next part is gathering information there on 13.10. What are some of the types and sources of information you're going to gather in internal audit of your auditee? Well, obviously policies at that high level of governance, policies, and then the procedures. Now, I've said many times, internal control narratives are what your internal audit function or your external audit function wants to look at. What's your control over cash receipts, cash disbursements, payroll, accounts payable? What are your controls there? And are you doing what you say you're doing? Because these control narratives are the beginning. And so these procedure manuals as well. Organizational charts, who reports to who, seeing the people's positions and their titles and their names, and seeing that there's a segregation of functions there. Job descriptions for these people. What are the educational requirements? Process maps, flow charts, depicting the overall flow, narrative descriptions of key tasks, copies of key contracts with customers and vendors. Outsourcing partners. What about relevant information regarding laws and regulations? All of this, very important. Okay, another one that's important is vendor master maintenance. Who controls the vendor master file? That's just like an employee database. Who's on your employee database, which is managed by HR, bona fide, true employees. Same way with vendors. Who's controlling that vendor maintenance file? Because it shouldn't be the same people entering vouchers and paying. As you can see, the fraud that can develop from that, which we'll talk about later. But who's controlling and updating that vendor master? And you may have to ask a bunch of questions there on 13.11, up there at the top. Asking individuals, what key tasks are you responsible for performing? What inputs are you looking for? What are your outputs for each task? All right, page 13.12. Of course, any data analysis is going to require the use of computers nowadays, right? And that can help a lot. Running reports that show you the number or percent of payments that are made well before or after the due date, right? Especially if you're trying to take a discount. Are you taking discounts or are you missing those discounts, and why? Stratification of payment amounts. What's the potential for procurement cards? P cards, that's something I hated as a controller. It seemed like our corporate office would say, well, you need to get as many of these P cards out there as possible. And I don't know if it's because of rebates or what, but anytime you give P cards out to people who are non-financial folks, the potential for making errors in what you're purchasing because they get it mixed up with their regular credit card, either intentionally or unintentionally, or fraud. But that gets pushed a lot, and P cards are something when you get out into the workforce, I would, from a fiduciary standpoint, minimize that. Duplicate payments is always something of concern. When we look at, and of course, generating reports, as we'll see here, part of the testing here at the end of this chapter, of looking at duplicate payments. The same vendor with same amounts or similar amounts. Maybe the invoice number has a 1 on the end, or a 2, or a -1, or a -2, or an A or a B, which means they put in a different invoice number. Because most software systems will not allow you to pay the same invoice number twice. That's just one of the controls that software gives you. But when somebody puts in something that looks like they're trying to override the system or trick the system, of course, you shouldn't be able to do that if you only got one receipt against that purchase order. It shouldn't allow you to do that anyway. But there's all types of overrides that can occur in certain situations. And using a separate vendor number or a separate invoice number or a unique invoice number is one way to do that. But computer-assisted analysis and testing is a big help. Talk a little bit about entity-level controls analysis there. Maybe a company doesn't have a commitment, or they don't want to pay what it costs to attract, train, and develop competent people. I ran into that at one time. In key areas requiring decision-making abilities and complex judgments. Maybe you alter the testing approach based on less reliance placed on these individuals. So these entity level controls, they operate really across the entire entity and not associated with individual processes. It's really a higher level, which may help you. What about documenting the process flow? Again, on 1313, process maps, flow charts, we talked about these high-level flow charts. Very important. Page 1314 and 1315. You're probably getting an eye twitch now, thinking back to data analytics. But this charting is very important, especially there on 1315. And we looked a little bit of that in that PDF I had from SAP, but the three-way match. Very important to understand those processes because this is real world, what they're showing you here in this textbook and that SAP diagram that I showed. What the accounts payable department is, maybe that's the scope of what's being looked at is accounts payable. Maybe treasury department, a little bit different shade there in their function, but you're really looking at the processing of invoices, processing of payment, purchasing is outside of that, of course, the impact of the general ledger. But there, the invoice, the three-way match, they don't call it that, but the three-way match there on the left-hand side, right, over here, you can see there, you got a PO, you got an invoice, you got a receiving. The one thing I'll point out, because this particular chapter does not, it talks as if the invoice is what generates the obligation, the liability. It does not. The receiving report, that's what generates the obligation that goes to your general ledger. Now, it goes into probably a clearing account as a credit, as a liability. But when that invoice comes in, that clearing account is debited out, and then the accounts payable is to that specific vendor. But make no mistake, the liability on your balance sheet occurs at the receipt of goods or when the services are rendered, right? So we'll make that clear because this particular chapter does not. In fact, you look at 1316 there as well, right? They do a great job of showing what's in red and what's in white. Red is showing the potential issues that could occur. And you see that across the page there on 1317. Look at number 1 there, for example. Invoice is not received timely by accounts payable, resulting in liability not being properly reflected in the financial statements. Well, that's not true, but it is an issue that you're not getting the payment in there in a timely manner to clear out the clearing account and get it to your accounts payable for Treasury to really monitor and see when they need to pay, whether they need to take a discount or pay it at 30 days, and not before and not later. So that's upside down triangle 1 there. Upside triangle 2 says invoice not processed timely by accounts payable, resulting in lost opportunities to take discounts. Again, all these red, upside down red triangles are potential risk, right? And then the ones in white there, and we'll just turn over on the next page, on page 1318. Number 1 says, as part of the month-end close process, the AP manager will solicit information on unprocessed invoices and prepare an accrual accordingly. Now, if you've got a good, decent system, and most software is going to do this for you, when those goods are received onto your general ledger, onto your software, it's going out against that purchase order that's sitting out there as a commitment. Commitment is there. It's not in your general ledger. It's out there in your procurement system. The commitment is there. The receipt is keyed in against that purchase order, and that will generate the accrual into the clearing account. And that's what 1 is saying. If you've got that, then you really don't have to worry about that particular step, although what usually is run at the end of the month or any given time is, what receipts do you have that you don't have an invoice for? Not to make an accrual. Well, if you've got the receipt with no invoice, the accrual's been made. But that's potentially where you don't have an invoice that maybe it hasn't been mailed to you, hasn't been electronically sent to you. So that may be an investigation of something that you need to look into. Potentially what you could have is a purchase order, no receipt, and then you got an invoice in hand. Well, you got the invoice, you should have had a receipt. So that's where you want to go and track down, as the goods been received and the documentation didn't get into the computer, or the paperwork didn't make it to accounting, or service rendered. So unmatched receipts or unmatched invoices are 2 different reports there. And item 2 there, to mitigate this risk, on page 1318, it says, once an approved invoice is entered, the system will automatically book the credit to AP and debit to the appropriate expense or balance sheet account. All right, so we could go through all of those, but you can read that for yourselves. Very good stuff here. I like the way they lay this out. Continuing on, let's look at page 1320. Here's identifying key performance indicators, KPIs. I wish I had $1 for every time I heard the word or the phrase KPI. Key performance indicators, and they're saying certain characteristics represent good KPIs, and they use relevant, right? You want relevant KPIs, measurable, available, aligned with objectives, and articulated. I know we always use what's called SMART, S-M-A-R-T, which stands for they're specific, they're measurable, they're attainable, right? And these are similar, although a little bit different. Attainable, they are what? They are relevant, and they are time-bound, which some of those are here. But SMART, we always use SMART because it's easy to remember that. Like a DMAIC map when we talk about lean manufacturing and so forth. So SMART, you need to make sure you've got SMART KPIs. And then down at the bottom, what are some of the KPIs maybe you're looking for? 100% of the disbursements are accurate. Yeah, you want 100% accuracy. That may not be attainable, but that's your goal. 98% are paid by the due date. Yes. No duplicate payments. Shouldn't be any duplications. 90% of the payables with early pay discounts exceeding 1% are paid in time to take the discount. Then you want to look at what are some potential fraud risk here in your testing and part of your plan. And this is one that happens. Look there in the middle of page 1321. An employee creates a fictitious vendor with his or her own address, submits an invoice for processing to that vendor, and deposits the payment to his or her own account. You got to really be careful. And I know at Nuclear Fuel, at Exide, at Lear, the whole vendor master thing was controlled by someone not associated with accounting or accounts payable. Maybe somebody in accounting, but somebody completely separate. You don't want somebody setting up vendors or suppliers when they could do what I just described there. They create a fake invoice, right? Because not always are you making payments through purchase orders. Sometimes there are non-PO payments, which is another red flag, which is another way that your computer assisted software can generate reports that show what are all the non-PO payments. If they're PO payments, then somebody else was involved in creating a requisition, the purchase order and purchasing, the receipt, and then processing the voucher for the invoice. Purchase order driven, a lot of controls there. Non-PO, sort of outside of that, and that does occur sometimes. Beware, and those are areas you can look at. Look at the second item there, potential fraud. An accounts payable employee processes a duplicate payment and through collusion with the vendor agrees to split the proceeds of the additional payment with an individual at that vendor. It may be the same amount, it may be a smaller amount, but generating a payment and what goes on between maybe somebody in your engineering or maintenance or environmental department with suppliers that they deal with on a regular basis. They forge these relationships and you get two people in collusion, in cahoots, as we say in the South. That's always a danger. But again, if it's purchase order driven, that's very difficult to do. It's no non-purchase order payments that are always red flags. And a third one there is a treasury employee sets up a bank account in a name similar to an authorized vendor and wire transfer funds to that account. Well, that's always potential to occur as well. But you need to understand the potential fraud impact. Always be skeptical of what goes on in your company. That's a tremendous trait to have as an auditor, whether you're an internal or external audit. The misappropriation of assets, the misrepresentation of financial results, two separate potential impacts on your business, the reputational damage that can occur from that. Then on page 13-22, we get into this next large section on identifying and assessing risk. You need to have specific process level objectives and choosing one at a time, brainstorm what the barriers are. And there you list several of those under item 2 there on page 13-22. And then you want to continue that for all your process level objectives, right? Talking about accounts payable and purchasing, your objectives there. And then your payroll, again, the segregation of functions. And I've said this several times. Those are two areas you want to spend a lot of time on. The payroll, having HR controlling bona fide employees, right? Bona fide employees and their wage rate. And then you got the timekeeping function, turning in timesheets of bona fide employees that are out there on the production floor. It doesn't go to HR, it goes to accounting. So accounting is recipient of what HR is doing as far as the names, the employee number, and their wage rate. You got production and departments sending time work to accounting. And so there shouldn't be anybody, there's no reason for HR to set up a fake employee because there's no time coming in to pay that person unless it's non-timesheet data like for a salaried person, but most have some type of timesheets that are used. But salaried people is kind of hard to hide. But the timekeeping function is from the department level. HR controls employee database. And you got accounting, the third group, actually processes the time that's been worked. Either they're looking at it online if it's through badge swipes or whatever, but they are going to validate that before they run the payroll process. All right, so those are all areas which would be good to incorporate into a text like this as well, along with the purchase to pay cycles, because that's where you're going to spend a lot of your time on very basic, straightforward audits. Top of page 1323, they give a books to buy example there. The following are a few of the many risk scenario examples of cash disbursement process. Invoices not processed timely to permit payment by the due date. I mean, this is, first of all, for taking the discount. And the second of all is not paying your vendors late. That's just poor practice. A duplicate payment is made due to an invoice being input twice, once from an approved invoice and a second time off of a statement. How many times do you tell people do not pay a vendor or a supplier from a statement? They all send statements out saying, these are the invoices that we sent you. These are the ones that have been paid. Throw them in the trash. You pay based on the original document that comes in. Now with e-invoices, a little bit different, but still a lot of companies still pay based on paper documents. It should be an original document, not even a copy. It should be an original document. And they all have unique invoice numbers on them. They should also have a unique purchase order number on all your invoices. And if you tell your vendors, suppliers, and this is what you should be looking at in internal audit and external audit, tell your clients, your auditees, that force those vendors and suppliers to put a purchase order number on every invoice. If you tell them we're not going to pay you yet unless you do, guess what? They're going to put a purchase order number on every one of them. So important. Control systems, which is a big part of this. It's internal audit and control systems. But original documents. An accounts payable clerk accidentally enters the incorrect amount into the system, resulting in payment of that incorrect amount. That can occur, of course, again, automating the purchase order, the receipt, and so forth. Sometimes vendors change the price. They might change the price 10 cents or $1. Some systems allow you to have a tolerance of, if it's less than 1% difference, go ahead and pay it. But incorrect amounts is not as big an issue as it used to be. Maybe due to employee turnover and accounts payable with their input delays, resulting in late payments. Maybe unauthorized individuals change payment terms within the system. Are they allowed to do that? Is your software not controlled on a security level that doesn't allow them to change the payment due date? There should be an automatic payment date based on whatever your system is or that particular vendor. Is it 2% 10, net 30? You should be taking that 2% discount or even 1% over 10 days, but maybe it's net, maybe this company that you're doing business with is net 20. Then somebody keys in the invoice, it should automatically populate 20 days from that time. And they shouldn't be able to override that. Any kind of overrides at the management level, which is always a concern in audit, should be at someone at a very high level. And there should be an audit trail of all of those that have been changed. All right, continuing on. Of course, there's a lot of possible cash disbursement risk there at the bottom, page 1323. HR is always, hiring good people is always important. What about evaluating the impact and likelihood of risk on 1324? I mean, assessing the risk, the various outcomes associated with each risk. Risk represents uncertainty, doesn't it? And of course, we measure that based on the financial impact. What's the potential exposure over a specific period of time, like a year? So that's step one, is determining the various outcomes associated with risk. And then part two on 1325 is what's the likelihood? I mean, if this risk is very unlikely, but has a high dollar impact, maybe it's very unlikely and a low dollar impact. You don't worry about those. But what's the likelihood, which is step two. And then step three is really creating a matrix, which is in figure 13-8 on 1326. You look at that matrix there, and what's high impact and high likelihood, like the 8s and 9s, and even the 6s, for that matter, those are the ones that you're really concerned about, making sure that you've considered those. The ones that are low, the 1s, the 2s, and the 4s, right? Low to middle, low to medium impact, and low to medium likelihood, all right? 5's kind of right there in the middle, 3, 5, and 7. Of course, 3, if it's low impact and high likelihood, it's not that big a deal. Of course, you need to quantify that with tolerance levels. What are the dollar amounts? They do a good job there, and they expand on 13.8 and 13.9 with this risk appetite. And then on 13.28, we identify key controls. And we talked about this back in chapter 6, as you recall. You know, what are the various controls, approving, right? The approvals, whether it's approval through the computer, which most companies do now, you know, like at ETSU. My executive aide will enter a requisition online. I have to approve it online, then it goes to purchasing. So that's a long process there, and a lot of segregation. Calculating potentially amounts, documenting or preserving the source information, examining, matching, segregating, all of that. Of course, anytime you have these controls, you need to make sure they're not redundant and not cost effective, because there is you've got scarce resources in this, and you need to recognize that as the auditee, you need to recognize that, and as the internal audit and external audit needs to recognize that as well, that something doesn't have to be controlled so burdensome that you can't even earn a profit, right? That's why you exist. So then in 1331, we create a test plan. Create a test plan. What controls do you want to test? Are there higher level controls that provide reasonable assurance, right? That relevant risk are managed? Are there compensating controls? Remember that term from previous chapters? Then we got to develop a testing approach and document that approach on 1332 and develop a work program on 1333. And of course, the budgeting process is important to this, and making sure you got the funds to actually execute this audit engagement, this assurance engagement. So that brings us to this last part I want to talk about specifically, about conducting tests to gather evidence, 1337. And what we see there is a couple of examples on 1341 and 1342, since I've been talking for more than 30 minutes. There's a couple of examples, and the purpose of the test says to test whether the delegation of authority policy is complete, appropriate, and current relative to establishing the authority for approving procurement and disbursement transactions. So what's the approach? Review delegation of authority policy and evaluate whether it appears to be current and appropriate. Sampling consideration. There are 147 individuals included in this policy. Given the small population and the nature of the assertion, right, continue to read on. Says the results of the testing after completing the initial sample, 3 individuals were identified who were no longer employees of the company. Well, that's not good. I mean, it's 147, but you've got 3. Why did you not update that? When did they leave? So because this observation, the test was extended to include all 147. Well, I take that back. If I'd read the rest of that on sampling considerations, they did every 3rd person. So they must have tested 49. So 3 out of 49, which is 6%. So they went ahead and did all 147, and 7 were no longer employees, one of whom had left the company 15 months ago. That's a long time, which tells you they haven't updated this in 15 months, right? All right, so recognizing the list was not updated timely. And then their conclusion there, that it's not operating effectively, and it's not. So that's a good example of expectations risk test 1. Then duplicate payments risk test 2 is something that you're using your software to help you. And this is probably the company's software that they're using for their procurement to payables financial cycle. And so they've generated this, and the test was to determine if there's potentially duplicate payments were made during the year. Doesn't mean that all these were duplicate payments, but they're worth an investigation because they've got very, well, identical amounts. It appears every one of these are identical, and they're not even similar. They're identical. And so look at ABC office supplies. They're on 13-42. 8651032, then they got 8641032A. One's February 21, one's February 20. Same amount, it may be okay. It may just be a progress payment for something. Who knows? Look at Alpha Printing and Binding. Looks like there they've got 48637899, and then they just added a -1 to the next one, haven't they? Did the same thing on the next one. And then the next one, they just added an asterisk on there, didn't they? Dates are a little bit, well, the first one's the same date. All right, that's a definite red flag for 125,414. Then the next 4 payments, the next 2 that are similar, looks like there's 15 days, 16 days difference, same amount. All those need to be investigated against the purchase order, against the source documents. It's part of your testing, the source information. I know what's going on there, right? The conclusion here, well, I didn't read all of this. I guess I should. You can read that though, but it says the conclusion, it appears that duplicate payments are being made in instances when invoices are presented twice, either with slightly different invoice numbers or with the same invoice number, and the individual entering the invoice has added a digit to the end to prevent the system from rejecting the transaction. Controls are not operating effectively on a consistent basis. So they're saying all of these, the assumption is all of these are actual duplicate payments. Is it fraud? I don't know. They didn't go into that much detail. Is something going on between who the requisitioner is and or accounts payable, that they're making this payment to the supplier and then they're going to split the money? Who knows? So that is chapter 13. We could have spent more time on talking about that, but I don't like to go more than 30 minutes. The summary, the rest of this, I've encouraged you to read. In fact, the entire chapter, and answer the deliverables for this, as well as the test case, or the test, not test, the case. Chapter 13, case 1, all multiple choice questions. So get that turned in, and next time we will look at chapter 14, getting down close to the